Hey there, everyone. Welcome to Chart This with Dave Keller. Happy Monday, July 13th, 2026. So glad you're joining me here on the show. We're tuning in from a beautiful day here in Redmond, Washington. High, it's currently in the mid 70s. We probably get to the upper 70s today. That is a scorcher of a day here in Redmond, Washington. I hope you guys are all hanging in there, doing well, staying calm and cool in the face of market instability, which is what it certainly feels like today as I'm debriefing on the charts. Hey, listen, this is one of those growth underperforming kind of days. This is one of those days when the biggest sector in the S&P by far, the technology sector, is struggling. This is a day when semiconductors start to look vulnerable. Anyone who has been riding up that fantastic rally in the semiconductor space, days like this feel pretty rough, enough to spike the VIX, meaning volatility is increasing. The MOVE index, which is like the VIX for the bond market, spiking up even further. We've got some defensive sectors, doing pretty well today. This is one of those days when I feel like recency bias can be super challenging. Recency bias is one of those things where to summarize, whatever just happened, you feel like that's always going to happen, right? Today's a down day. It's a new bear market. Today's an up day. All right, great. Down day. It's a bear market. A big up day. All right, it's a new bull market. And we make long-term decisions from short-term data. As I like to say, make short-term decisions with short-term data, make long-term decisions with long-term data. There are some charts that are looking a little bit vulnerable. And I think the way that you improve your success rate using charts to identify opportunities and manage risk is to put a little more shall we say, structure, a little more discipline to your use of technical analysis. What differentiates a chart that just kind of isn't looking great anymore versus a chart that has violated a key level of support with strong negative momentum? Both of those things could be used to describe the same chart, but one of them feels like a hunch to me, and one of them feels like you're actually grounding it into a strong set of rules and discipline. And let's try to navigate more toward that sort of part of the spectrum if we could today. If you're tuning in live on Facebook, LinkedIn, YouTube, and X, thank you so much for doing so great to have you here, and I appreciate you being a part of the show today. If you're tuning in live, you can ask questions all along the way. I can see during the live stream all of the questions coming through. I will do my best to answer some during the live stream. If you're watching the show later on our YouTube channel, thanks so much for checking it out. And use the comments section there on our YouTube channel to ask any questions. We had a great mailbag episode on Friday, by the way, and if you missed that one, strongly encourage you to check that one out. It's always a really good exercise going through some of the great questions you guys have asked, but digging in when we have a little more time to do so. All right, here's what happened today in the major averages. The S&P down 0.8% to 75.15 and change. So, still safely above our line in the sand. Still not quite a great breakout of that coil pattern, right? On Thursday and Friday of last week, we had a nice break out above the coil pattern. And Friday was this fantastic update, right? This is Friday's session here on the chart. I mean, kind of a choppy open, then like a fantastic move to the close. Today we opened weaker, but then just gave back all of Friday's rally and more. And that's what you have to remember when you're just looking at one day's movements. Remember, over a series of days, you can be giving back a lot of those gains. You can be regaining a lot of the losses. So thinking about what today's movements means within a larger context is quite helpful. I would say at worst, at this point, the S&P is still in a consolidation area. Base case scenario, we're still trying to break out of this coil pattern. We'll get to the chart of the S&P with some implications here. Going into earnings season, of course, which hits this week. We've also got some inflation data coming out. It's going to be a busy week, folks. The NASDAQ composite underperforming today, down 1.6%. The NASDAQ 100 was down almost 2% today. So, mega cap tech really struggling. The semiconductor space, as we'll cover here through the course of the show, really starting to show some vulnerability. And unfortunately for the benchmarks, those provide a huge weight in the benchmarks. The good news is there are plenty of stocks that were up today. It just wasn't those big names that have big weightings. Note here, and again, the Dow Utilities Index is not one of the most important indexes I've ever tracked, but I think it is noteworthy that, for most of recent weeks, the Dow Utilities Index has usually been in the red. And if it's been in the green, it's been in the green less than the S&P and the NASDAQ. This is one of those days where that's flipped, and the Dow Utilities, the Dow Transports are both up while the S&P and the Nasdaq are down. So that speaks to a bit of a rotation here today to start the week. And as I mentioned, the VIX had a pretty good move higher today. It wasn't as much of a spike during the day. I mean, we opened above 16, but then pushed all the way above 17 through the course of the day. So this is sort of a steady grind higher in volatility through the course of the trading day today. Now I should, because I didn't grab the chart of the VIX. I just want to mention the MOVE index, which is kind of like the VIX for the bond market, spiked even further today. And that concerns me even more than this, because the bond markets generally, right, the fixed income markets tend to be way more focused on risks than the equity markets. And I'm generalizing, but equity investors often are focused way more on potential returns, hitting the next home run, picking the next big winner. Bond investors have as much passion and focus on potential downside risk, because their job is to assess whether a bunch of companies, whether different sovereign, states, governments will be able to meet their debt obligation, because those defaults are what cause some real issues in the bond markets. And so they're very good about thinking about downside risk. So when the bond investors get nervous, when credit spreads start widening, when the MOVE index tells me bond options investors are betting on some potential downside, that catches my attention. And we're seeing a bit of that here today. Just one day, but let's make sure we keep an eye on that. The VIX still, of course, below 20, so the VIX is not giving us any big red flag, but this was a significant shift up over 2 points from Friday's close. Interest rates generally continuing higher today. We've seen a rotation over the last couple of weeks. The 10-year Treasury yield trending lower, now starting to turn higher. The 10-year yield finished today just above 4.6%. The long bond yield's right at 5.1%. Higher rates tend to have some interesting implications for the equity space. And I did put out a video. I'm sure it's not ready yet, because I just sent it just a short while ago. But later today, maybe tomorrow morning, my weekly episode on Stock Charts TV will air, and that is where we focused on the interest rate environment. I focus on 5 financial stocks, one of which I'll show you here today in a little bit. But I'd encourage you to check that out. But higher rates tends to be not great for technology, because it's all about discounting future earnings. And higher rates today basically means those future earnings are just less valuable today. And so it suggests we should be paying less for the future earnings of big growth companies. Not good for tech. Should be great for the financial sector. Should be bad for home builders. There's a number of things you can think about, right? And just generally think about who has to borrow money. Higher rates are probably not good, right? So not good for homeowners, not good for small companies that have to borrow money in an early growth phase. Higher rates tend to be good for banks, which make their money on the shape of the yield curve. And so those kind of headwinds and tailwinds, I think, could become more and more pressing as we go through earnings season here. And really just think about what higher rates could mean. When we get inflation data Tuesday, Wednesday this week, that could certainly cause some shifts in rates as well. The dollar moving higher as well. So we've got the interest rates moving higher. We got the dollar moving higher. I think those are concerning developments at this particular moment in the cycle. In the commodity space, I mean, the real story is a significant move in the energy complex, right? And we've been speculating about this potential move. We've been sort of framing it out as, look, given the headlines out of the Middle East, I can't imagine that things like we're in any sort of all clear yet. Just seems more volatile than the market was pricing in. As a result, I've made some bets for higher crude oil prices. I'm currently owning a double long energy ETF that is doing pretty well today. So today, not surprisingly, I would say, given the fact that we're seeing a re-escalation of the conflict in the Middle East, the memorandum of understanding doesn't appear to be holding particularly well. As a result, crude oil, Brent crude, both up over 9% today. So we're seeing a bounce higher. Energy stocks, of course, are at the top of the list. So I think that, no matter what, I think the energy space remains quite volatile here. Would not be surprised if there's plenty of volatility in crude oil prices. Crude oil, by the way, back above the 200-day moving average with today's move, as we'll show you in a few moments. Gasoline futures up. Nat gas, sort of the only area within the energy space that was down today. Kind of mixed results in the soft commodities. In the metals, generally lower here. Copper was basically flat today, but gold and silver both kind of rotating lower, generally following what we saw in the equity space here today. Looking at the cryptocurrency space, we can see all of the top 10 coins here in the red. Bitcoin currently trading just above 62,000, and that's down 2.6% from Sunday. You can see this is Sunday's trading here, generally kind of choppy, waiting for the US Open and then the equity open. And going into the equity open, generally Bitcoin, Ethereum, all trending lower. All right, looking at the 11 S&P sectors, I mean, great day if you're owning energy stocks with the XLE up 3%. Of course, as we've covered here, many energy stocks, not surprisingly, tied to the price of crude oil, and generally higher crude oil prices will mean the energy sector is going to do pretty well. There are some exceptions there because we've seen energy stocks making new highs. Names like MPC come to mind that fit that bill, but the energy sector more broadly doing very well today. A lot of those starts really sort of trying to bounce off of a recent swing low, but a nice start to the week. Utilities, number two, up 0.7%. That's a fairly defensive sector, of course, a higher yielding sector. And then financials, number three, up about 0.2%. And again, higher rates generally good for financials. On the downside, and that's the big one, technology down 2.4%. That is a big drop for the biggest sector in the S&P. If all the other 10 S&P sectors were up, tech down 2.4%. That's almost an unrecoverable drop with that key, again, very large sector. But consumer discretionary down 1%, not helping. Industrials down 0.9%, also not helping as well. Worth noting, by the way, value stocks generally did okay today. They did okay, right? If you look here at the 11 Morningstar style boxes, you can see growth is where the bright red is, particularly large cap growth, right? These are the NASDAQ 100 names. These are like the SMH members, the semiconductor ETF members. They're all sort of in large cap growth for the most part, down 1.6%. You look at large cap value, small cap value, essentially flat for the day, slightly higher. But that's the real difference right now. Growth really underperforming. And the problem is in the US, for sure, our benchmarks are dominated by growth, not value. So even if value is slightly higher, it's not going to really compensate for the weakness that we saw today in growth stocks. Looking at the breadth conditions, honestly, kind of mixed here today. You can see on the NYSE, definitely more decliners with only 45% of that exchange higher today, while 53% were lower. But if you look in the S&P, kind of the opposite, right? 54% up to 45% down. Mid-cap and small-cap indexes almost a wash, sort of a coin flip between advancers and decliners. Kind of a mixed breadth day, I would say, overall. Here's where things get kind of ugly and mostly in the color red. Hey, let's start with the good news. Microsoft was up 1.5% today. I mean, that's still not a great chart, and it's still trying to find its footing, but it didn't go down today. Amazon trying to get above 250, not quite doing it, but holding its holding in there. Apple did briefly make a new swing high, but closed back toward the lows of the day, so not much of an upside follow through. The real problem are on these names that were down quite a bit today. Micron down over 4%, as was SpaceX. SpaceX now trading at 139, below the opening day trade of 150. Broadcom, along with Micron, along with Nvidia, all down today. The SMH had a really rough day. Tesla down over 3% as well. So some big drawdowns today and a lot of key growthy names. As we get to the chart of the S&P, you'll see why that's a pretty big deal and why it's a problem. As a reminder, we're live streaming on a number of platforms: Facebook, LinkedIn, YouTube, and X. I appreciate you guys so much. Those that are tuning in live, you are welcome to ask questions all along as we go. We'll take some questions along the way. Anything we don't get to, we will put them into the mailbag. Maybe we'll feature your question on Friday's episode. We've got a little more time to do so. All right, so here's what the heat map looked like, and it was again a pretty rough day, specifically for technology, right? And if you look in the upper left corner, you're going to find a bunch of AI related, chip related kind of names, and that's three of the top five charts in that XLK technology sector. Nvidia, Broadcom, and Micron, all in the semiconductor space, all down about 3.5% to 4%. But if you continue to the next five, which round out the top 10, four of the next five are in the semiconductor space as well. All of them were down over 4%, some down 5-6%. So pretty big give back day. And again, it wasn't just one part of the semiconductor space; it was all over. So like storage names like Western Digital and Seagate, both down about 5%. This is pretty widespread. So what was up today? Because you can see a bunch of green is all the software stocks, right? So Adobe, which I would argue is undeniably a really ugly chart still, bouncing higher. Palantir, which is coming off of a new, 52-week low. So I would not describe that as a generally strong chart. Kind of bouncing higher. Salesforce, which has been an ugly chart for so long, not down today. So it was almost like the names that were up today, it was more that they weren't down, right? These are charts in primary downtrends kind of bouncing off of a new swing low. So I would say from a technical perspective, not great charts. As a swing, like you could see the swing trade type of feel there. But the charts, in terms of the medium term, the long term time frame, I would say still, I mean, those are some of the weakest charts I would identify in technology with the names that were up today. So certainly a mean reversion today off of semiconductors into software. The trends have been the opposite of that now for quite some time. Let's continue on talking about some things that were struggling today. Marriott, this is a problem. Marriott's a name we've been following for quite some time. I mean, the chart of Marriott through mid-June, about as good of a chart as you probably would find. I mean, just a pretty decent uptrend, making higher highs and higher lows above all the upward sloping moving averages. The momentum pretty strong. The problem now is today we go back below the 50-day moving average. We have traded below the 50-day, like back here in March. And I think what you want to notice about that sort of period is we traded below the 50-day for like a day or two, but we really didn't lose much after that, right? You can see that we sort of stabilized, right? The downtrend sort of ended the moment we started pushing below the 50-day. And that's an encouraging sign, which suggests there's some accumulation down around this range, right? Like 310, 320. This is when investors are pretty happy to take some shots, and eventually that rotated the stock to a new 52-week high. We would need to see more of that, right? Because if you sort of take a big step back from your monitor, this has been a pretty good stepwise move with some nice surges higher to new 3-month highs, and then a pullback to at or slightly below the 50-day moving average. Well, we're kind of slightly below as of today's close. The RSI right below 40, currently at 38 and change. So right at that point where I think you can no longer call that a really decent pullback and start to call it more of a larger corrective move. So I think Marriott, and the problem I have right now with this market, there are a lot of Marriott kind of charts out here, charts that aren't necessarily horrible charts yet. They're just not great charts anymore. They're kind of good to okay. And when the great charts become good to okay and the good to okay become bad, that's what a top can often look like, right? And that's why I'm concerned by patterns like this. Names that I've been following that have been such clear winners, now all of a sudden not looking as clear of winners. Still okay, but just okay, right? I mean, that's it. And I would say other hotel names to review, or travel names that are kind of in that same bucket. Hilton would be another one. HLT also coming off of a new swing high and rotating lower. RL's another one. I mean, it's down 5% today. The problem with an RL is we had this fantastic break above like 380, 385, ended up making a new high above 400. It's given all of that breakout back and a little bit more today, down another 5% today. So some previous breakout names that made the market look pretty good in June, Q3 is starting and they're looking a lot more vulnerable. And again, the other issue is earnings season starts this week. We've got a lot of financials this week, although some random other like healthcare and industrials mixed in there. I've got a couple charts just to share with you of names that are reporting this week. But over the next couple of weeks, we're going to get a lot of earnings on a lot of stocks, and those charts that look just okay could look pretty negative, certainly if earnings disappoint. So those are some of the areas looking negative. Materials we don't have time to get into, but a lot of charts like Newmont Mining have been struggling with their underlying commodities like gold or copper starting to struggle. So if those are areas of the market looking rough, what's looking pretty good? We mentioned software. Energy, of course, comes to mind. And I would say charts like ExxonMobil, I would say still more to prove. They sure look like they're bouncing off of a low, but not like, on ConocoPhillips, you're not really breaking above a trend line yet. It's more sort of short-term breaking above or breaking off of a low. So I would say a lot of these still don't look great just yet. There are some great charts in the energy sector, and the good news, they're going up too. And the three that come to mind, Valero, Marathon, PSX, those are three energy names. And we mentioned this last week as all of them ended up making new 52-week highs. So further move to the upside there. So the energy sector is starting to look pretty interesting again. And then the financial sector, and this is one we continue to come back to. As I mentioned, rates are going up right now, and in the month of July, and that generally is good news for the financial sector. We'll probably be covering a lot of these in detail through the course of the week as we start to digest earnings. I would say keep an eye on the payment processors like Visa and MasterCard. Both of those names had some pretty steep drawdowns last week. Nice start to the week, kind of regaining some of that drop that we observed going into last weekend. All right, shall we continue and look at some charts together? Let's do it. Looking at the daily chart of the S&P 500. So last week we talked about this move on Thursday, finally breaking out of this coil pattern. Friday with a nice follow through. So a coil pattern like this, a breakout day, a follow through day. I would argue the path of least resistance is now up. Today we basically got down toward the lows of Friday's session. Still okay. But again, bit of a pullback after that breakout. Now, if you're all bulled up, here's what the bullish scenario would look like, right? We break out, you retest the breakout level, and then you have this big surge higher. That's a classic, well documented pattern that happens often in the technical analysis world. When you're looking at enough charts, it's so frequent where you have a breakout, a retest, and then a new move higher. It often will happen that initial breakout or that initial pullback after that big breakout move. And maybe that's what's happening here. I think we want to watch some of these short-term levels, particularly the 50-day moving average would be one I would be following and make sure we hold that. And if not, then we have to start thinking about maybe re-entering the coil pattern. Maybe it's a different pattern, maybe a bigger basing pattern. And this is more just a resistance range and a support range. That might be how I would start thinking of it. But for now, do we hold the 50-day on any sort of pullback? And if so, that's pretty good. Momentum still hasn't surged to the degree we'd like to see. You'd want to see an RSI pushing above 60 to signify new accumulation. Not there yet. I'm going to pepper in some random charts that just have me a little bit. I don't want to say concerned. That's not the right word. But I'm noting some lack of support for a bull thesis here. It's not so bad that I would say, look, this is the most obvious sell ever. I don't think that's happening right now. And certainly the trends that I'm observing are still, not too bad. But I am noting that while the equal-weighted S&P has already made a new all-time high in the month of July, the equal-weighted NASDAQ 100 definitely has not. As a matter of fact, the last real high that the NASDAQ 100 made, the equal-weighted version, I mean, you could argue it was at the beginning of June, and you could think of these as sort of secondary tests of that resistance. But, basically since the end of May, the equal-weighted NASDAQ has basically been sideways while the equal-weighted S&P has been going higher. And I call this the new Dow theory. This is sort of adapting Charles Dow's work using the Dow Industrials and the Dow Railroads, kind of modernizing that for the old economy versus the new economy. And this has served me pretty well, just looking for confirmation and also looking for non-confirmation. It's starting to feel a little bit like that, right? That one part of this chart is continuing to go higher, like all's good. And then a different part, the NASDAQ, not particularly going as strong. I'll tell you what is strengthening as bond prices are going down. It's rates going higher. So the 10-year yield through the end of June in full pullback mode, right? We were seeing a clear downtrend in rates, but now just in the last couple of weeks, we're seeing the 10-year Treasury yield break above that pink trend line. And that, I would argue, that indicates a new uptrend in rates. We're back above the 50-day moving average. The moving averages are sloping higher. And I would say at this point, higher rates seem to be the rule, not the exception for the foreseeable future. The problem, if rates would continue further, is that really starts to put pressure on technology valuations. As I alluded to earlier, you have to remember, just Google, present value of future cash flows, right? Present value of future earnings. Sort of the way that you think about how or a fundamental analyst would think about valuating a technology stock. All of these companies have talked about these great earnings that are not here yet, but are expected to come. And all of the spending on AI infrastructure is going to be worth it by the incredible amounts of money that these companies make. And that could very much be true. But the question is, how much should we be paying right now for those earnings that we're expecting years down the road? And if interest rates go higher, the way the math works is that's in the denominator of that valuation formula that most fundamental analysts use. So if the present rates are higher and higher, that means we should be paying less today for the future earnings of those companies. And so it's just a lot of people will be talking about how it's not worth it buying technology stocks given how we have to value them. And that just can often put downside pressure on prices when people start to question that. So rates going higher could be an important headwind slash tailwind for different areas of the market. And certainly as we begin Q3, that's the environment going into earnings. With today, and today again was a bit of a significant move day in a lot of different asset classes. Besides equities pulling back today, you've got the dollar spiking higher, you've got crude oil spiking higher, we've got gold rotating lower. Gold's right at $4,000 an ounce, which is where we've bottomed out a number of times here in the last month. On the Market Misbehavior podcast, go back a couple weeks to my interview with John Kolovis. We talked particularly about the stronger dollar. I love to ask guests these days, what's like that one chart you're watching that you think would provide a really good warning signal if things would really start to turn south for equities? And John's answer was the U.S. dollar. I thought he had some good reasoning as to why that was the case. So I've definitely had that in mind as I see the dollar rotating higher here today. Crude oil prices, as I mentioned, spiking higher. We're up to $78 a barrel. As of Friday, we're down around 71, 72. So it's obviously a pretty big move higher. Of course, this is tied to headlines out of the Middle East, certainly suggesting that this is still a very active and volatile situation, and that the Strait of Hormuz is open / closed / governed by whoever says they want to govern it. It's a little unclear, I would say, in terms of reviewing as many headlines as I can. What I'm telling you is the market's a pretty good way of aggregating all of that sentiment because this is telling you what investors are thinking, and investors are betting on higher oil prices right about now. We've been talking about $80 a barrel being one of those kind of cutoff levels, and we're getting very close to that with the spike higher today. Move above 80, I think people that have been ignoring that, and I think reasonably so, can't ignore that. That's once again sort of an issue for this market. Let's see. Offense over defense. I was looking through charts over the weekend for my premium members. We do a weekly flight plan, which we put out every weekend. By the way, would love to have many of you join as premium members. It is not an inexpensive service, but hopefully it is well worth it by the better decision-making and portfolio management skills you are able to nurture by following the things we discuss. You can go to marketmisbehavior.com/premium if you want to learn more about our premium memberships, which include virtual courses, our member-only reports, also our member community. I was in there earlier today answering some really good questions from our premium members from over the weekend. But one of the charts that I was noticing as I was preparing for that weekly investment report was offense over defense. And if you look, are these horrible charts? Like, they aren't, but it's just very noticeable that these are definitely not going higher, right? Are they going lower? I don't think so at this moment. Are they going up? I think absolutely not. And so what's happening is the S&P and the NASDAQ, we're talking about where they are relative to all-time highs. We're talking about upside resolutions to chart patterns. But the reality is, in the consumer space, we really haven't seen positioning that is usually coinciding with a big bull market rally, right? A healthy bull market, we need a lot of stocks making new highs. We need offensive areas of the market doing much better, and we're just not getting that. We talked about semiconductors and issues in the technology sector. Here in the consumer sector, we're just not seeing the bets on offense that would normally be a part of a bull market thesis. And so for me, that just means any rally, we have to have kind of put them in asterisk and say, yeah, good move in the major benchmarks, but here are all the things I'm not seeing that would make me feel a lot more comfortable with what I'm seeing on the chart of the S&P 500. Let's see. Growth over value. Talk about a rotation from the growth side into the value side. In the top panel, this is the Russell 1000 growth versus Russell 1000 value indexes. We're actually using the iShares ETFs, which is an easy way to track that ratio. If that line's going up, growth's outperforming value. If it's going down, value's outperforming growth. Through the end of May, really looks, you could see the outperformance of growth coming off that March market low. That all changed in June. We really haven't seen a return to growth in July just yet. Now, the bottom panel uses what are called the pure growth and pure value indexes because there's a lot of double counting, right? A name like Microsoft is considered both a growth company and a value company. You're going to love this. SpaceX actually gets graded pretty well for value metrics. Go figure that one. But sure enough, it's in a bunch of value ETFs starting last week. And so names like SpaceX and Microsoft, allegedly show a lot of similar characteristics of growth stocks and also of value. So those are kind of in the double counted area. So we eliminate those for these pure growth and pure value ETFs. It just shows the buckets of stocks that are not double counted. And that one, I would say, has clearly started to rotate lower here in the month of July. So, what does that mean? We've been talking about this leadership rotation away from tech and other growth into areas of the other areas of the market, like industrials, like healthcare, like financials. And I would say the breakdowns in these ratios really show that rotation that we've been talking about. It's really starting to take hold. I don't think it's the end of that rotation just yet. All right, some individual stocks and ETFs to wrap up today's show. Here's the chart of the semiconductor ETF, ticker SMH. We have just a classic, I'm talking textbook bearish momentum divergence in the month of June. We've covered this with a number of different charts, right? The chart of Micron has a very similar kind of bearish divergence, as does other semiconductors, but the SMH is a great example of higher highs in price and lower peaks in momentum. When the market's going higher, you want to see strong momentum, which indicates that the up days are super strong and the down days are kind of light. When you see that shift, when you see new highs, but the RSI is not making new highs anymore, that suggests that the down days are starting to pick up steam. The up days are not as strong as they had been. That's what that RSI ratio is essentially measuring. And so it starts to imply that there's distribution happening that's not yet reflected in the price. And that's why we often look at bearish momentum divergences. We're testing the 50-day moving average here. This is pretty close to where I would say the chart of semiconductors starts to look fairly negative. We're also looking at some short-term support here, right around 560, 565. We're kind of actively testing that as well. So SMH, a vulnerable chart going into earnings this week. Morgan Stanley reports earnings, they're up on Wednesday of this week. It is a potential head and shoulders topping pattern. And I will tell you that because we've got a left shoulder, we've got a head, we've got a potential right shoulder forming. We come down here and test that neckline and then break below it. I think that would be a pretty classic topping pattern. The 50-day moving average is right on there as well. So keep an eye on that one to see if we have a test of support. Again, earnings can often provide those moves that complete those price patterns we've been identifying. JB Hunt is another one. This is more of a logistics name. They're reporting later this week. JB Hunt is one of those classic kind of sideways charts. I love to quote Jesse Livermore. There's a time to go long, time to go short, and time to go fishing. This is one of those charts that I would say it's neutral. I mean, it is just a definition of neutral from a technical perspective. Highs are consistent, lows are consistent. We're in a range. We're in an equilibrium. Buyers and sellers are kind of in agreement that the stock is worth around, $270. So what we wait for is a break above the upper boundary or a break below the lower boundary. And the direction of that move would confirm the next shift in momentum. I would say at this point, neutral, momentum, super neutral going into this week's earnings. Hey, to finish on a high note, because I was going through the charts, I'm like, man, I'm finding a lot of things that just are not really supporting an upward trend here. Hey, Dave, ticker DAVE, made a new all-time high so far in the month of July. Overall, still a great chart. So Dave's in an uptrend. That's good. How bad can life be? In all honesty, as we continue on through the course of this week, there's going to be a lot of earnings. Certainly, we've been talking about consolidation in the S&P and the NASDAQ, and we'll keep an eye on that one as well. But let's take a question or two before we finish off. All right. Thanks for the question. Apple is very resilient. Look at the 5-year chart. If you day trade, sure, look at the candles. But if you buy and hold, the Apple chart is a good one. I saw someone had mentioned the Apple being I think it was a gravestone doji, I think you said. Let's take a look here. All right. So, honestly, like I look at candles all the time, but I don't look at them here. And I often get that question. The reason is because at this time frame, if I'm looking at a year and a half of data, I started looking when I worked at Fidelity and started working with fund managers that were trading not for the next 24 hours, but for the next 24 months, if not quarters. I learned to bring in more and more data. So I would start looking at weekly, even monthly charts when I would sit down with a portfolio manager. And as I looked at charts on longer time frames, bar and candle charts are pretty much, they show the same information, but the benefits of candle charts are pretty minimal when you zoom out far enough. It's just kind of clutters the view. So I start looking at bar charts, but then I always have a candle chart ready to flip over to if I want to think about that short term action. I would say you're right. Probably call that a gravestone doji, maybe a shooting star candle. You could debate that depending on how you have your y-axis configured, but yeah, open and close near the lows of the day, long upper shadow. So that suggests the next 1 to 3 bars more likely lower than higher. The problem when you see a candle like that, as we're trying to get to new highs, that's the problem, right? So when you're trying to get to new highs, we want to see bullish continuation patterns. We want to see signs that there's plenty of room left in this uptrend, plenty of gas left in the tank. This kind of candle implies that we're on fumes and that we're not quite to the gas station. The car's slowing down. And that usually implies the next 1 to 3 bars or lower. Now, to someone else's point, right? You're right. I mean, look at multiple timeframes. And I would say one of the problems I would argue that investors and traders often get into is just insisting that one time frame is all you need, and insisting that whatever time frame you're looking at is the right one. Which we have to remember is we're all kind of trying to answer different questions at times in our portfolio. So the right chart for me may not be the right one for you in terms of what game we're trying to play and what time frame we're trading, our investment horizon, our risk appetite, and all of that. What I would say is I have yet to meet a single market practitioner of any time frame who could not benefit from thinking about the other time frames. If you're day trading, look at some hourly and look at some daily charts and think about what the little daily moment to moment little squiggles mean as part of a larger context. Because there are a lot of accounts managing funds with a lot of zeros that are not looking at a day trading time frame and are making bigger decisions that are going to impact what happens during the trading day. And if you're a long-term investor, if you're a position trader, don't be afraid to look at some of the short-term data like candle charts, like hourly charts, to just think about how the market is reacting to short-term news, because that can tell you a little bit about the mental state of investors and the sentiment. And think about that tactical time frame. So I think we get into trouble when we put the blinders on and look at just one time frame for any of us. I think we could all benefit from what we call multiple time frame analysis in the technical analysis community. There was one other. Yes, thank you. A number of you mentioning when in doubt, zoom out. A+ on that one. At Titus Writer, welcome, my friend. Thank you for watching as always. I haven't talked about Netflix in a while, and I'll tell you why. Two things, as you probably have caught. Number one, because the chart's been so ugly for so long, and at some point, I'm cleaning up I had the Magnificent Seven and Friends, which we now call Dave's Dirty Dozen. Like, I don't think Netflix fits in there anymore, right? I mean, at one point, it was like you had to pay attention to Netflix because the story was streaming. It's like we've moved on to so many other stories. Having said that, it's still a pretty big name with lots of shareholders. So your question is it a breakout and fail, or the pros setting the TA trap to grab liquidity? Interesting chart. What's really interesting about the chart of Netflix, which I think you're kind of alluding to, is we are testing some major lows, right? I mean, if you look, this February low right around 75, we went all the way up to almost 110. And then round tripped all the way back to those lows. And then we've slightly undercut it. We're oversold right here. So it's like, this is one of those really interesting times where it could start to, improve. And I think on the weekly chart, especially, you can see how, we're sort of testing these lows, and we clearly undercut it a little bit. We're still kind of in that general range. So what do you do in this environment, right? This is one of those times when I think, if you're trying to just identify when the momentum starts to shift, I would say use an indicator like RSI thoughtfully. Like, look for the RSI to push above 50, even 60 on a rally, which would imply plenty of accumulation. Look for the volume to start to improve. An indicator like Chaikin money flow can be really good to capture that. My go-to is like a weekly MACD indicator, which should, probably is more of a confirmation for some of us, but also can provide some really good confirmation that a low is actually in. Those are some of the indicators I would use on a chart like Netflix. But folks, we are big time out of time. Thanks so much for watching here on Monday, July 13th. I appreciate you tuning in live. Those of you that are doing so, and those of you that are watching the show later on YouTube, welcome. We've had some great episodes of the Market Misbehavior podcast. Another episode should be out momentarily, I want to say, maybe first thing tomorrow morning, and we're recording one more for the week tomorrow. And then I'm going to be on the road. I'm headed to Boston later this week and I will be probably an adjusted publishing schedule. I'll keep you guys updated here on our YouTube community. So make sure you subscribe to the YouTube channel. I'll let you know as soon as I have confirmation about when the shows will air. In the meantime, have an awesome night. And remember, it's always a good time to own good charts. Take care, folks.